All right, let's talk about trading. We're going to dive into a pretty big topic, trading's hidden traps. We're going to figure out exactly why most traders fail, and more importantly, how you can be one of the ones who actually succeeds.
So let's start with the big, scary number you always hear. Why do over 90% of aspiring traders fail? I mean, that is a huge, staggering statistic. Is it because they can't find some secret, magic indicator, or because they don't have a perfect, flawless strategy? Well, it turns out it's something else entirely, and that's the central question we're going to unpack today.
And here's the answer, right up front. It's not about the strategy. It's about the enemy within. You know, the biggest obstacle you're ever going to face isn't a crazy market or a broken system. The real battle is internal. It's a fight against our own psychology, our own biases, our own bad habits. So let's break down exactly how you can win that battle, pillar by pillar.
Okay, so our first pillar is all about mastering your mind. This right here is where the real work begins, because you could have the most amazing, sophisticated trading strategy in the world, but it's completely useless if your own emotions are secretly working against you.
The core problem we're talking about is what some people call emotional hijacking. This is that moment, and you've probably felt it, when the logical, rational part of your brain that built your trading plan just gets completely steamrolled by raw emotion. You know, fear, greed, hope, panic, they suddenly grab the steering wheel and drive you right off a cliff.
And this quote just hits the nail on the head. You can spend months, maybe even years, doing research, building discipline, perfecting a system, but in the heat of the moment when there's real money on the line, all of that hard work can just poof, disappear in an instant, all because of one emotional impulse.
And these emotional impulses show up as some really common mind traps, like psychological override. You know this one? It's when a trade goes against you and you move your stop loss just hoping, praying it'll turn around. Or what about revenge trading? You take a loss, get mad, and immediately jump into another trade just to get back at the market. Then there's confirmation bias, where you only look for news that agrees with your trade and totally ignore all the red flags. And finally, you've got two sides of the same coin. Overtrading, just clicking buttons because you're bored, and analysis paralysis, where you overthink a perfect setup so much that the opportunity just vanishes. Every single one of these is a form of self-sabotage.
So how do you actually fight back? You have to build some mental armor. First step, have a rock-solid plan. Define every single action, your entry, your exit, your risk, before you ever get into a trade. Second, use what you could call mental stop losses. If you feel those emotions starting to bubble up, you have a rule that says, I'm done for the day, I'm stepping away. Third, things like mindfulness can really help you stay calm and focused. And finally, journal your emotions. This is huge. Don't just track your profits and losses, track how you felt. This is how you start to identify what your personal emotional triggers are.
And that brings us right to our second pillar, mastering your method. This is where we need to talk about escaping the Holy Grail myth. You know, the belief that there's some perfect magical system out there that never ever loses. This idea is one of the most destructive traps a trader can fall into.
Because that belief leads to this behavior called strategy hopping. It's a vicious cycle. A trader finds a system, they have a few losing trades, which, by the way, are a totally normal part of any strategy, and they immediately decide, nope, this system's broken. So they jump to the next big thing, and the next, and the next. They never stick with one method long enough to actually master it.
And you can see the difference so clearly here. The strategy hopper is always chasing perfection. They ditch their plan at the first sign of trouble, which just leads to endless frustration. But the professional? They trust their edge. They know that drawdowns are part of the game. They stick to their tested plan, and they build real skill over time. And that is what leads to consistency.
Now, besides strategy hopping, there are a few other method traps to watch out for. Over-optimization is a huge one. This is when you tweak a strategy so much that it fits past data perfectly, but then it completely falls apart in a live market. It's like making a key for a lock that doesn't exist anymore. Then there's ignoring context. You know, having blinders on, staring at your charts so intensely that you miss a huge news announcement that's about to rock the entire market. And finally, there's stagnation, just failing to adapt your strategy as the markets inevitably change over time.
So the solution here is to forge a method that's truly robust. First, you have to backtest it thoroughly so you understand its real performance, including what a normal drawdown looks like for that system. Second, keep it simple.
Seriously, the more complicated your rules are, the higher the risk that your strategy is just curve fit and won't work in the future. Third, use testing methods that show how your strategy performs on data it's never seen before. And last but not least, stay informed. Always know what big economic news is on the calendar.
Okay, this brings us to our third and final pillar, mastering your money. Look, you can have the perfect mindset and the best method in the world, but if you don't manage your capital like a business, you are going to fail. It's that simple. This is all about the discipline of survival. And a huge piece of this puzzle is avoiding what's called death by 1,000 cuts. This is what happens when all those tiny little costs that you barely notice, commissions, fees, slippage, add up over hundreds and hundreds of trades. They slowly bleed your account dry and can turn what looked like a profitable system into a losing one.
Which leads us to maybe the single most important rule in all of trading: 1%. That's it. That is the absolute maximum amount of your total capital you should ever risk on a single trade. Period. Why? Because this one rule is what keeps you in the game. It ensures that a normal string of losses, and trust me, it will happen, can't just wipe you out.
And of course, there are other money traps that are just as deadly. The number one mistake is definitely position sizing errors. Risking way too much on one trade is the fastest way to blow up an account. We already talked about ignoring transaction costs. Those little fees can absolutely destroy your profitability. And finally, poor capital management, like pulling out your profits way too early, which stops the incredible power of compounding from ever really taking off.
So, we've covered the 3 pillars: mind, method, and money. How do we tie all this together? Well, it really comes down to a fundamental shift in how you think. The path to consistency isn't about trying to win every single trade. It's about perfecting your process.
This slide really breaks down that crucial mindset shift. Someone who's fixated on the outcome just asks one question: did I win or lose? The problem is, a lucky win from a trade you executed badly just reinforces a terrible habit. But a process-oriented trader asks a different question: did I follow my plan? Following your plan perfectly, even if the trade ends up being a loser, reinforces the discipline that builds real, long-term consistency and mastery.
So look, if you take just one thing away from this whole explainer, please let it be this. The solution you're looking for is not a secret indicator. It's not a holy grail. It is an unwavering, non-negotiable commitment to a disciplined process. A process that governs your mind, your method, and your money.
And that just leaves us with one final question for you to think about. Next time you look at your trading journal, ask yourself, is this just a record of what the market did, or is it a map of my own mind? Is it showing me my own habits, my own triggers, my own process? Because that right there is where you'll find the real path to success.